I think
Yes. If
everyone's been
anyone
very
has any
patient.
more questions, we have some 10, 12 questions here. We are gonna go through each one of them. If you have any more questions, just post in the chat, just post in the group. Oh, sorry, just post in the chat over here. We have question and answers section as well. And then we can go through, cover them all. So let's start with the questions that we have, Ashish. First of all, you answered where are you based? The other question that we have from Christian again, which we put it for later, is that is it fair to say a good broker and an accountant removes the need for financial planner? I haven't felt like I've needed one yet. Would love to hear your opinions. So I will just give my opinion as a broker, because it's sort of addressed to me as well.
Yeah.
As a broker, you still need a financial planner and broker and accountant. When you look at just property portfolios and investment strategies, sure, they do the job for you. Accountant can give you the tax part, they can build you this trust and other structures, whatever you need, and the broker can give you the borrowing side of things. So that just takes one part of the financial planner. But then, that being said, insurances, how your portfolio should be. Should you diversify? Should you have jewelry? Should you have stocks in that? That part is needed to be covered by financial planner. But controversial opinion would be don't ask property advice from a financial planner. They are just gonna give you a very conservative sort of approach and advice, which I have never seen worked out for anyone. So you do need a financial planner. We don't want to discredit any profession. They are very important. But then we cannot overlook them, but also not 100% follow with them from what they are saying. You do need to have a property mindset person looking at advising you on that.
And insurances, but you've answered really well.
Yeah. What do you think, Ashish? What are your thoughts on that?
Yeah, just I think in addition insurances, I don't think financial plan. Look, I I did a course from Tony Robbins. It's called Wealth Mastery, and there's similar to buyer's agents who are charging the buyer and working a bit independently. They're called fiduciaries. And what's in depth in diversification, I think we are not privy to that information.
Yep.
And finding the right person is really hard, but you are spot on. Property, you may not get, you sometimes they go against property buying and your mindset suddenly changes. But for insurances, anyways, you have to go to financial planners. So, but you answered well.
So is it a paid tool? Yeah, most of them are paid tools. There are some free tools as well. We are going to, in the email after that, we will cover all the tools, portfolio dashboards that we used into the email. That's going to cover everything. Should we also look for positively cash flow properties or negatively cash flow properties are also good investment, Ashish?
Like it depends on the strategy. There is, I would say there is no property cash flow positive in today's market. So the bank charges 6%. Let's say it's 100% loan. The property will have 10, $12,000 in holding costs. So for a 600, 700K property, you're already talking 1.5, 2%. In order to be positive, you need 7 to 8% returns. Now, it depends on my journey. When I'm starting out and I'm a low income earner, I'll buy a bit cheap. By buying a bit cheaper properties, you can push the rentals up. That's a good strategy to start with and reduce your holding costs, which I also started in the same way, but I've never compromised on the quality of the area. And that's why I actually started buying smaller lots and smaller homes by going into good areas. But for people with, let's say, one property costs you 1,000 to 1,500 a month to hold, and you can buy two properties. And people think, we have to buy one a year. Yes and no. You can buy one every 2 to 3 years as well, but it only takes 3 to 4 years for a property to be positive. The rentals will go up even if you don't pay the price, even if you don't pay principal and you're focusing on paying the owner occupied debt. Eventually the property will become positive. It's the holding cost over first 3 to 5 years, which pinches a bit, but I am a value investor where I'll find a balance of the yields, or I'll go with commercial properties if I have to chase yields. But getting a decent cash flow really works wonders in your overall portfolio journey. So I'll say you find a balance if you're starting out or on a low income. And if you are on a decent income, anything beyond 220 to 250, every family is saving $5,000 to $7,000 a month. You focus on growth, but balance it with cash flow a little bit.
Yeah, well said. Yeah, your property is the most expensive the day you buy it. After that, today's climate interest rates, it's very difficult to find the right positively cash flow property, which also gets you capital growth. So it is going to be negatively geared because you are borrowing at high LVRs or whatever the reason may be. And later down the line, it's a 30 year or 15, 20 year, whatever your holding capacity is. It's a long term game regardless. So eventually it is going to be positively geared after 2, 3 years. And you are also going to get that capital growth on that. So either way, it just depends, as Ashish said it, you have to balance your portfolio with that. So again, both are good options, but hard to get good cash flow positives in this climate. The next question again is the same. Do I need a financial planner before I invest in properties, or a strategist like Ashish can give me an idea of how many investments will help me achieve my personal goals? It's from Jayesh.
I, I'd say I'd say uh, working through goal setting session by yourself or either with a property strategist should be enough. They can work through the property easily for you. What I'm going to do is I'm going to share a link of the webinar that talks about the goal setting and portfolio building concepts. So for someone who's starting out, I think that video is going to work wonders, and you should be clear on the goals and why people build goals and things like that. And the example is, and why even diversify into multiple properties and when to diversify into commercial properties. So all those questions are answered there. I'm going to share that in the chat now.
The other question, I'm going to answer this live. How can we buy a property interstate and how to trust property is good? So basically, this whole 1.5 hours is what we discussed for that. So I think that hopefully answered your question. Otherwise, we will put a link to this video when we upload it. But I think it's a long answer. It's just what we exactly discussed right now. No offense, but yeah, anonymous question. But the next question is, do you work with some financial planners who advise on property buying too?
The financial planners can't advise on property buying, but they can work on the assets,
Yeah.
and they can tell you how to diversify and how to plan your assets well. But I work with financial planners. I can always guide you to a few. Look, that's the beauty of working with someone in our roles. I've got a network of professionals across Australia, starting from conveyancers, town planners, architects, financial planners, and I've got some tried and tested people because I've had really bad experiences with a few financial planners myself. So, yeah, if you need anyone, feel free to approach separately or send an email and I can get an introduction done. And
A fairly
since,
big question next. Sorry to cut you off, Ashish. Uh, did you want to add anything more? Sorry if I cut you off.
no, no, I was just saying that I will now just share that link with everyone.
Yeah.
So, there you go. That's a YouTube video that talks about portfolio building and goal setting concepts.
Just put everything into an email as well after that, because just to give the gist of everything. Because in this one, I think the chat is just with host and panelists. Not sure if you can share with the
We
audience as
can.
well.
I've done it done to everyone. Yes.
Okay. Okay. Cool. 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 The other question is: it's been 5 years for me in Australia, still renting and not able to understand how to leverage debt. We were born with mindset in India. Again, I agree with this, that loan is bad debt. So how can you become rich with debt? So regardless of where you are, first of all, that is a common question across the board. We all thought that debt is bad. That's how, like, we are risk averse. We don't want debt on our books. It's a loan, and which something you have to repay. We don't want that responsibility ideally, but we will cover that. Where to buy as first home buyer? Northwest, Southwest, they have not mentioned the city, but like not sure what which city they are in. Home is emotional, but we feel like after coming from India, living high class lifestyle, living here life of uh don't want to use the word feel like want a lavish house. So basically, they are trying to compare that. Is going for an owner occupied a lavish house, which, like, that your goal is, assuming they are in Sydney, it's gonna be like somewhere in the range of 2.5 plus. Anything below that is just very basic in Sydney. So how do you balance that? And like, they don't want to take debt. They want to understand if debt is good or if debt is bad. How to make the bad debt a good debt. So it's a really broad question. I think you need to sit with a broker who can explain to you the benefits of that, and also sit with an accountant who can explain to you in numbers what benefit are you getting. Because If the debt is helping you grow your funds and money, like that's what the goal is. So how can that debt be bad? If it's appreciating, if it's giving you income, if that is giving you something out of that. Let's say if you buy a lavish car or like a really luxurious car out of that, or spend money on watches and clothes, that and you take loans for that, that could be a bad debt. For good debts, like if you're investing, if you're buying stocks, or if you're buying something that is returning more than the interest you are paying, that is a good debt. And it could be in the form of capital growth, it could be in the form of rental income, whatever that may be. So if you are getting more from the debt, if you're just your financial situation is improving, that's what you want. So that is the sum of that question. Regardless, regarding your other questions, we can personally, like, you can get in touch with us and we can explore more with that on you. Um, I think is that would that cover the answer, Ashish? Should we move on to
I
the next
think
one?
I'll sum it up. Look,
We have 10 more
the
questions, so
yeah, the person who's asked the question should search on rent vesting. There's no harm in rent vesting. I'm rent vesting still, so I'm going to buy a home, but eventually, right? So but what I've done has given me enough so I can go and buy a home debt free if I have to. Or home is also an asset. Um, that's where you need to just change your thought process a bit. Search about good debt, read Rich Dad Poor Dad. Um, so yeah, just it's a good debt is what we are leveraging. The rest would depend upon your budget. So happy to separately have a chat or feel free to give a call. My number's there. I can guide you on areas too. But the bare minimum
that
you have to
also
spend 1.2 to 1.5 million to enter Sydney market.
there's one more question about rent vesting. Someone anonymously said, "Great Prezzo, Ashish and Rahul. Question for both of you: Are you rent vestor or do you own your own PPR?" Which you just answered. I'm also a rent vestor because I believe in the strength of rent vesting, and given my lifestyle, it suits me the best. I would rather live in a decent sort of a place where I can afford the rent and not have to spend 2-3 millions on a property, and would spend that whatever capital I have in investing in interstates and in other locations. So I believe in that, and all the tax benefits I get from that, capital growth I get from that, rather than putting into one place. Um, the other question is, heard units depreciating, many property sold for less than what they bought within 5 to 6 years. Yeah, Ashish, do you want to cover that?
Yes. Sorry, what's the question? I can't.
Units depreciating, many properties sold for less than what they bought for within 5 to 6 years. So I think they're talking about units. The units are depreciated in value in Sydney or like a lot of locations.
Look, yes, that's right. But units, it's not depreciating, but yes, they lose value if you bought brand new and at a premium. For units as well, you can, if you buy well located units and older buildings, it may not be a bad option or a choice. And units people buy because they want that comfort and convenience, but then it comes at a cost of a slower growth at 3 or 4% year on year. They will still grow. And the other point is people think they are good in cash flow, but when you factor in strata and other charges, I reckon your cash flow is also depleted fairly. So it's a lifestyle choice, not an investment choice though.
Perfect. So next question. Looking for my first investment property, is that good to approach a buyer's agent? Having an ambitious target to reach in 10 years. I am 43 years old and I would like to hold minimum 3 properties in next 10 years. I have already missed the 6 months as I got my pre-approval in Jan 2025. Whether I can achieve the target with some of the what some of friends have achieved who invested before 2-3 years. Thanks, GB. So GB wants to know that.
So I just why can't I see these questions? I'm seeing
If you
from
just go
Dheeraj.
below, there are questions in
Oh,
at the bottom. You'll
okay.
see Q&A.
Can you just click on answer live as well? I'm actually looking at Q&As, but
Okay, let me just do answer live on this
okay,
one.
okay,
So sorry.
I found it. I
Yep,
found
yep,
it.
yep, yep.
Anonymous looking for first investment. Is it good to approach a BA? Look, the whole point was so you can do it yourself. But if you need a BA, I'll extend a small discount to anyone who comes through this chat. And I will send an email just as a gesture of respect. You've spent a lot of time. So you have an ambitious target to reach in 10 years. It's not difficult. but a pudding can only be as sweet as much as sugar you put inside. So if you have the money to start, it may not be, it is not difficult. A lot of,
Very
I've
old
shown
saying,
you
right?
people have done. Yeah.
It's a
So
very old saying that the best time was to buy yesterday, the second best is today. So just go for it.
yes, and minimum three properties in 10 years. If today I'd say they're giving you 500 a week, that's 1500 a week in rent. That's $75,000. Actually, yeah, about $75,000 a year. In 10 or 12 or 15 years, we can definitely assume they would double in value. So, yeah, just it's not a bad target. And you've missed 6 months as you got your pre-approval in Jan. Dilemma in um, whether I can achieve the target with some of the friends achieve who invested before 2 3 years. Look, yeah, just to Rahul's point, you've missed it. That's fine. There are different type of opportunities in every year, different strategies that you can follow. Never buy because you feel you're missing out on. So again, have a conversation. Happy to guide you to a certain point, and if you need any support, I'm happy to support you as
Robert wants to know, are you taing this 6-year property cycle into your client strategies, considering we are about a year or so at the end of the cycle? So do you know the context of that, Ashish? Or do you want to
I
more
know.
information on that?
The 18.6-year cycle comes from a book called The Secret Life of Real Estate and Banking, which, if you can see there, it's a very thick book. But
Oh,
18.6 year is a business and another cycle, which is, I think, mainly governed by US. It may be right, maybe not. I go by the cycles that the states follow in Australia. But overall, I think debt to income ratios is what needs to be considered and see how the debt is increasing as well. And that's why most people go into tier two and three cities because debt to income ratios are not that bad and the population movement is still there. Um, but yeah, just the end of cycles is generally when people start to move outwards, or there's been 3 4 years, state has been growing consistently. Not necessarily that 18.6-year cycle holds true here, but property cycles, yes, they do. But that's just what my understanding is, and I may be wrong.
hope that answers your question, Robert. Next question is, Ashish, if I have 200,000 to invest, should I upsize PPOR or where did that question go? Yeah, for
Yes,
CGT free or selling or buying an IP.
so this is a personal choice. Do you need to upsize your PPOR? And selling and buying also incurs costs. Buying a PPOR, if you are in Sydney, for example, you are incurring stamp duty again and selling costs as well. So after incurring all those costs, what is the benefit to you and your family? Is your
They want to know
house
about the CGT part, like compared
CGT
to
free
IP.
on selling? Yeah, but then
Yeah,
they sell CGT free money. They put in that CGT amount into the other new property, but then they're paying stamp duty and the selling price on the first property anyways. So the and there's still no tax benefit. So that's another consideration that you can do. Are you getting tax benefits already? Are you on a really low income? And these are few questions that I'll answer before I can figure out what my next steps would be.
yeah. So it depends on situation to situation. You would need more information before you can guide them through that. But if you don't need the PPR upgrade, go for an investment would be financially as a financially savvy choice, I think.
Yep.
Any metrics? Oh no, I have a very old property on a big block. I'm gonna answer this live. Is it better to add a granny or should I consider knocking it down and build two duplexes?
I had a very dear friend ask just a very similar sort of question recently. So, look, um, I think it's at the end of the day, it depends on numbers. I think most development sites don't make people money. Development is that you get in, make 20 25% return on total cost. On your cash on cash returns become 60 70%. You come out in 2 years after making money, at least 25 to 30% cash on cash returns each year after year. Now, this property was in Adelaide, just as an example. The best return for my friend was to build a granny, and at the same time, you can renovate a little bit on the old house as well. That is for cash flow strategy. If you think you can make money, what I suggest is you do all the numbers on the build cost and the subdivision, which will cost anywhere between 30 to 50, knock down two bills, and then figure out what you want to do. Do you want to take the rent or you want to sell? And if you are selling, would you really make money? That's based on the area. Work out on the numbers, call a real estate agent, ask all the numbers, see the rentals, and see what your strategy is and what are you going to do with that money and so much CGT that you'll be paying. So that's again a few considerations there.
Got it. Okay. The next question, I think that's it's also for you. Any metrics to decide of disposing property in both scenarios? First, if property has capital growth, and second, if there is no growth at all. Cut your losses.
Actually, that's what exactly I've done. One of the property I had in Windham, but I bought in 2017, so for 365, and that was the least grown property in my portfolio, and I've sold it. Some of the properties I've also sold because I've got like 250,000 or about 60% growth in about 2 years' time. With such high growth or such low growth, I've sold both type of properties because I can deploy money into better assets. So again, answer to your question, in a very similar way, if the property has a very decent capital growth, my question is there still potential to grow? If it is in Melbourne, I'd suggest you hold because you'll be making more money because buying and selling would incur costs and you pay CGT. And then what are you going to do with that money further? Can you deploy into better use? If not, just stay where you are.
All about the opportunity cost. Next question again. Um, I have a sorry, where was I?
Arpan, what I've done is what I'm
Yeah.
doing is answer live and then clicking on done so the question just
Okay.
ticks off.
Okay, got it. So, Arpan, does it make sense to cash out the equity from investment property and pay off the PPOR? Wow. Okay. So in this situation, I you are taking out cash from equity from investment property, but I'm not an accountant because there are tax side of these things, which I would rather leave an accountant to comment on your personal situation. But the general information on that is you can do that if you want to make that property debt free, right? That's your personal choice. You just want to debt free, but there is no tax benefit to do that. Even if you are taking equity from an investment property and making it an investment loan, you can't make it a tax deductible debt because it depends on the purpose of what you're using the funds for. If you are using for the PPOR paying off, you are just paying PPOR debt rates are lower. So your let's say your interest rate is 5.59 on an owner occupier. Now you are taking debt from investment property of let's say 5.89 and paying this 5.59% loan. You're not getting tax benefits on that because the purpose is still owner occupier paying off. If you claim tax deduction on that, ATO can come back in 5 years and penalize you on that. So again, just general information, talk to your accountant. But the only reason, like, what it makes sense in my head is you want to make that property debt free, reduce the debt on owner occupier, have that less stress, then you can do that. Eventually, if you have enough equity and you just want your property owner occupier to be debt free, you can also do that. But speak with your accountant about the tax side of things. Ashish, do you agree or do you disagree on that part?
Fully agree.
Okay. Next question. How much negative cash flow is considered for healthy foreign investment property?
Look,
Hmm.
it's based on your situation. I've seen people paying 2,000, 3,000 as well a month. I unless you are purely deploying cash, just because you have a lot lying around. So I won't suggest going anything beyond 1,000, 1,500, but that also would depend on your personal circumstances. How much can you hold comfortably? But ideally, most properties are doing 1,000 to 1,500 as a max. Can go up to 2,000, but that's about it.
Yeah, I personally like I don't get any negative gearing because I buy everything under trust. So for me, the goal is to optimize and be in accumulating phase as of now. So as long as there's enough capital growth in the properties I'm buying, the negative gearing part does not affect me much, even though I can't claim anything under the trust. So it depends on your situation, your goals, and how much your cash flow is.
I,
So
I think the point also is, Rahul, that the trust may not be you cannot claim negative gearing, but you still have to pull in the funds where the trust is negative because it can't then sustain itself. So, but I believe it just depends purely how the cash flows are, because we have to at the end of the day make sure our family is safe and sound as well, and we are spending money where we need to spend.
100% agree. Your cash flow, as long as there, you comfortable do that. Don't don't put all eggs in the same basket. So should we diversify into stocks? Again, financial planning advice. We are literally into property and loans, home loans. We can't comment on whether you should do it or not. Personally, yes, why not? It's always good to diversify. Always have some savings, have some gold, have some stocks, whatever you want, but in certain proportions. Okay, so that I'm just gonna say done. Um, I majorly invest in property. I want to know if you have done it or not. Yeah, we do, but not right now. Like, it's not that goal of this is how to buy like a buyer's agent. That borders with financial planning. We can't comment much on that. NDIS property. How does one increase the chances of getting the
Actually,
right one?
Rahul, I'll answer that question. Look, I believe in diversification, but I also know property has worked wonders for me. So yes, the way I've invested is by buying into cash flow assets, growth assets balanced by cash flow, and now developments. For me, that is diversification. Investing in different states is also a diversification, but that doesn't mean like Victoria, I've gone crazy, like 7 properties just in 7 years, and then sold few properties, but that I capitalized on the one boom cycle because I could. So, but at the same time, I'm now feeling that I'm not diversifying enough because at the end of the day, one asset class may be impacted by economy or other situations. So it's better to be safe than take so much of risks. But again, it's not something that we can advise on. But I'm fully invested in property. Just to answer that.
Perfect. NDIS property. I just cracked when I. Sorry, do you want to take that, Ashish? I would not be the
How
right person.
does one increase the chances of getting the right one? Look, I feel it's a risky asset. While I've gone crazy on properties, I've been very careful and I'm very risk averse as well. So as Warren Buffett says, you figure out what the loss can be on the money that you're spending and what the upside can be. And while we are very happy to get 20 cents on every dollar spent, good investors get $5 upswing and $20 loss max. Sorry, 20-cent loss max. So to answer this, I feel it's a risky asset. You go with a trustworthy advisor who has the access to SIL, or they are tied up with a good SIL provider and they know the market and they also know the demand in that market and they can showcase that demand to you. But when you build that property, you'll not have a tenant until you finish the property. That's a big risk for me. I've not been able to overcome that at all. So I go with tried and tested assets. If you're going with NDIS, you rather are good to go with commercial property instead, which is less risk, tried and tested asset over multiple decades in the past. That's at least how I would think.
As a broker, I do loans for everything. I'm not going to comment on if it's good or bad. If you need finance for that, feel free to touch up anytime. Answer done. Create session. Please discuss about commercial properties such as shops or warehouses in the 500,000 range with solid cash flow, 30% deposit. I'm curious how that compares to investing in residential property, particularly in terms of returns, risk, and financial options. Would love to explore the pros and cons between residential and commercial investments. Ashish, please
I'll
go ahead.
share I'll share another webinar on this, which compares everything. I think that's much easy rather than covering in detail
Sure,
in
we can
this.
cover that as well. But in case if you need commercial loans, you know who you to get in touch with.
Ghostbusters.
In Australia, the government is intelligent enough to lock you either to pay taxes or pay interest to banks. Eventually, money is not with personal unless you get very good returns. Inflation is adjusted and you feel the property is not giving great returns. I feel except you own a company business, you don't save much being a taxed employee.
Is there a question?
Yes. That I mean, I think they just want to share like get our views on that, which exactly as you mentioned that having a company gets you in a lower tax bracket. That is general information. Uh this is more like we are not authorized to talk about these things, even when we want to share our opinions. And because it's such an educational platform right now, we are doing it could be misconstrued as tax advice or finance advice. But we agree on the sentiment as you are that that's how the taxing system is based. You have a lot of benefits going self-employed or have that sort of structure working for you, a company structure for you. I know you're not accountants, but wanted to get your thoughts on this. I have heard about unlimited borrowing capacity in trust, but the bank still assess your personal debts when calculating servicing. How do people get around this? Okay, so I have spoken about this multiple times, and I put the same strategy for myself and for my clients. Whoever is an ambitious investor, this is the really good strategy for them. I'm not going to be able to comment on again tech side, whatever that, just from borrowing power perspective. First of all, it's a myth that borrowing power in trust could be more. Let's say your total borrowing is 750,000. Now you want to borrow under a trust. First of all, there is no negative gearing. So your borrowing drops by 20-25%. So you are looking at 600, 650 borrowing capacity as it is, straight right off the bat. Now, if you buy for a 600, 650 property, you are maxing out your first purchase to 600, 650 lending. That's a wrong way to approach. You want to keep some space left in that. So from that 600, 650, you want to borrow about 500-ish maybe, because the 650 borrowing is your total borrowing under that trust, first of all. So you want to pull equity out in future. You want to have that 100, 150 space left in this one. You have set up another trust if you want to go for another purchase or do under your personal name. When we do this, your accountant should give you the letter to say that XYZ trust, the first trust you have bought the property under, is self-sufficient. If you are able to get that letter, we can take you to some lenders who will not look at that loan and liability as your loan or liability. That is a separate entity in terms of bank size, which is self-sufficient. Your accountant has confirmed that. And banks will say that your 750 original borrowing capacity is still intact under your personal name. Again, if you want to go under a different trust, same thing, 600, 650. So it can work, but again, the tax side of things, you don't get negative gearing, XYZ, all the other factors. You need to speak to an accountant, but from borrowing power and borrowing capacity, this is how it works. And a lot of clients are utilizing this. I have clients who were told no by banks that you cannot go for this property. This may be your last property. I have stressed them to 3 or 4 or 5 different properties as of now, and still have their left that bid still going on. Like they can still go for multiple properties. So that is possible as long as you can come up with a deposit, either in terms of equity from the properties you're buying or keep saving faster. So that is how that works. I think that answers this question. There are so many more coming in. Okay, Ashish, do you want to take the next few?
Okay, I think I'll go from the first one. Just the first one was how can you buy property interstate and how to trust property is good. Oh, okay. I think
I
this
think we
is
already had
yeah
this
covered.
one.
Yeah. Do you work with
Financial advisors
financial
done.
planners? We've done. It's been 5 years. I think this one also we've gone with the mindset. I think this one also we've answered.
Yeah, this is done.
Now, Dheeraj has
Dheeraj,
asked, it's a bit technical. One of the challenge I'm facing with DSR is that I feel the data is about 3 months old when I search with the median values as per my borrowing capacity and I start looking for properties in the selected suburb. I feel the market has gone out of my hands and not much available with my borrowing capacity. Do you feel the similar challenge? Look, Dheeraj, I mentioned few setbacks because it's a hot market. It's not a warm spot and you have to have that vision to go into areas a bit early, but DSR won't give you that, and the trends are not common. You can't get warm spots in hashtag terms. So yes, data is old and should not look at the median, you should look at the asking price, but the asking price also I know is fast changing. So you can always look at a council, how the council is approaching, and pick the right suburbs in that council. That's one approach you can do. But yeah, just that the challenge is definitely there, which can be overcome by hashtag, by the way. Just but yeah, just sorry that gap is there.
hashtag is not sponsoring us, by the way. He might not be aware we are promoting him that much. Uh,
Yeah,
what is the
I'd love
next?
to call him here. I'd love to call him here, but yeah,
Let's get him sometime if we can.
yeah.
So the
So
next question again from Dheeraj, when we see the land around the suburb, how can we know if the demand will outgrow the supply? Assuming the houses are built on the available land in around 18 months. Ashish, this one is for you as well.
look, the land around the suburb, I'll go with council approvals and maybe look at there's a website called openlot.com. So that tells you how many developers are in that area. But if there are no developers or there are acreages, not necessarily that land will come to the market at least for next 5 to 7 years. If you're buying at the right time in the right area, that is one full boom that you're gonna get. But if there are a lot of developers, and then even if there are two or three developers, I'll call them and ask them how many lots they've got, how much have been sold, what is their capacity. A developer like Stocklens can at max bring about 150 lots in a year. A smaller developer cannot do more than 30 to 50. So even if there are three developers and 150 lots, and with the population moving in, I don't think you should be worried. Back in 2016, 17, no, sorry, 18, 19, there were 2,300 migrants moving to Craigieburn every single month, not even a year. So that demand is nothing. So I think sometimes we miss out on what the demand is and when people are moving. And when you're buying in outskirts, and if it's a right next door suburb to an area which is fully consumed in terms of the land supply, there's no greenfield areas. I reckon you can target those areas too.
Next question, Ashish. Let's just keep this one for last, and up to you if you want to answer that. That's a $15,000 question. Which areas are you buying in? Okay, perfect. You are in for a treat, everyone who stayed. Do we need pre-approval every time? Not every time. You need a pre-approval. Usually, it's just a very comfort sort of a spot for you if you have the pre-approval. But let's say you just recently bought a property, you got your credit assessment done, and then after that you are going for another one, you probably don't need another pre-approval. If you already had one previously, nothing has changed, financial situation, your credit history is still intact, you don't need another pre-approval every time. It's just safer if you're something has changed, if you're self-employed, if you're buying under a trust and you already bought something under the trust, then in these situations it becomes advisable to have a pre-approval and a fully assessed pre-approval, not a system approval which you can just get straight away from the banks. You need a system, an assessor looking at your documents and giving you the confirmation after checking everything that you are able to borrow that much. So again, to answer, not every time, but it's recommended to get that just to keep you in a safer space. So next question, Ashish.
Yep. What is the exit criteria for an IP? So, Sasi, that's a good question, and it's very personal choice. But I'll tell you my criteria. What I look at is based on when I'm selling, and until you've not made at least 300,000 or 250 to $300,000, you don't walk away with much, because about 10 to 12% is your buying and selling cost. So let's say I bought something for $300,000. Let's say $500,000. Buying and selling is about 60,000. So 560 is my cost, and which includes everything, by the way, even selling cost, and then the holding cost as well, right? So over a period of 5 years, if the property has costed you 12 to 15,000 and it steadily reduces another 50,000, then my cost is 600,000. Now I won't be selling it until at least it gives me 250K gross. So I'm walking away with at least 150K. Plus, of course, the costs and all come back. So I have at least 250K with me to spend further. And again, keep in mind on that 150, about 20%, 30,000 goes in uh, capital gains tax, right? So that's what my criteria is, making at least 220 plus. And if I can make 220 within 2 years, I'll sell it straight away. That's how I've changed my mindset, because I only want cash flow oriented assets now. Because I think one really important consideration, and this is the most important consideration of the entire thing that I've said, and I'm going to say in a couple of times on every thing statement that I make, but when you are sitting on heaps of cash flow, income is the most important consideration. The heaps of equity that you have in your properties is not going to help you. So this is people who hold premium properties, or they've bought in Sydney and the properties are now valued at 1.5 to $2 million, but they're renting for 850 or 900. It's not going to help you. You eventually have to move to a high cash flow asset, and that's what my selling criteria is.
I love this question from them. And as I also discussed before, that real estate is mostly game of finances with some properties in between. So real estate, this is what you're getting into. The goal is to make money. If you feel you're maxed out in this property, you have made enough money, and you feel like, let's say, the days of market is increasing in this property, in this suburb, and the sales are falling flat, the growth is not as much. This is where data also comes into the picture. You can exit and get the capital growth and buy the next one in the next high growing suburbs. You can still get the appreciation in the next suburbs much faster that you will keep by holding this one, even though you have to pay capital gains tax, all of these things. But as Ashish said, that 220,000, like, I did not have a figure. I did not put this in quantitative terms, even in my head. But this gives me also a clear idea of when you should sell. 220 is a really good number on one property. Um, I also love the next question from it's anonymous, and I can see why it will be anonymous. Um, Whoever asked this question, thank you for that. Property market is dominated by men. I'm going to read it slowly so that I can think of an answer in my head. How can women get into that who are not trained in the jargon? So this is why we do these things, right? Education, empowering everyone, and especially women. We need to be more encouraging. We need to be like, giving them more like, awareness of how you can do that and more strength and power. Like you can do that. So it is like it's we can't even deny that women are like decision makers in that. I can like I surround myself with everyone, like my mentor is a female, right, from in finance, amazing broker. The people that I work with, I surround myself with like really good people, like they are a mixture of all genders. We treat everyone equally, we don't think of that way, but obviously the whole market is not a small, like it's a big sample size, not just particular individuals who are that way. um, and I think it's all comes down to understanding and educating yourself. So by what we do, we have our own community where 14,000 people are. And out of that, I would say I have seen the numbers, right? 31, 32% are females in the age group of 30 to 45. And they are also coming off, they contact me all the time, how to get pre-approval. And we give them all the knowledge, all the data that they have, which should, like, I hope, help them to make the decision faster. We are also encouraging female buyers agents to come into the picture and get on the property market. Female real estate agents, solicitors, so they are there in property game itself, but on different platforms, on different professions, not directly related to property. But hopefully things are changing. And if you are asking this question, and if you got some value out of this, I hope that encourages you to get into market more and you know buy your second, third, or first property, whatever that is. And if we can help it in anything, let us know. That's all we can say in that. Ashish, what do you think of that?
Look, I laughed at the question, but I think it's a very touchy subject. And that's an amazing question, and I really appreciate you asking that question. I deal with a lot of um, females who either have been divorced, men as well, but second category is where the husband has passed away, and that's where they realize the importance of finances because they have no knowledge. And once someone asked me, Ashish, can you please put in a series for Asian women? Because most subcontinent women are so busy doing the household stuff. My own partner, I asked her, let's make a series, I once said, of finance things. And she said, don't waste my time. Who's got time for all of this? But good thing that the first step is knowing that you need something. Second step is finding the right thing. So if I can recommend a blog called propertychat.com.au, I've learned a lot from that blog. This is origination from a blog. I've just mentioned a book in the webinar chat. It's called Building Wealth Through Investment Properties in Australia. It's written by Jan Somers. Jan Somers had a blog called Somerset, and from there, Property Chat came in origin. Simon Hampel, I think, runs it. So really good blog. I've learned a lot from it, but that's ideally the step, right? Finding resources, getting to courses, following influencers who are putting educational content out there. And I think that's the only way to learn. But knowing that you need something, I think is the first step, and you've already won that. So good on you.
Thank you for asking that question. Next one. Would you put villa townhouses under the same category as apartments when considering capital growth?
Um, a very good question, and I will not put them in the same category. Villa and townhouses grow really well, well-placed assets, but they strata titled blocks. So because the same land is not split in 10, but maybe split in three or four. So your growth may be a little bit less, but they've been growing really well. I've seen some townhouses in Wentworthville that was sold around 12, 15 years back, around 300, and now they're selling for 900. That's three times the value. I reckon these type of properties are now growing really well. So I'll put them in a category where, you can't buy a home, you don't want to buy an apartment, and that's where the balance is.
Perfect. Yep, I agree with that. Do you reckon end game is to live on rent or sell portfolio and invest in something with good cash flow. Even on higher side, residential property portfolio gives 3 to 4% rental yields before tax. Ashish, your thoughts on that?
I think I've mentioned this already. Um, Build a base and then focus on cash flow, or while building a base, start with growth oriented assets and then focus on cash flow oriented assets. Because when you sell the assets that have made you enough money and they're returning 4%, you've actually paid off the assets that are not making you enough money, but they're returning you 6%. So there is a balance, and that's what I've learned over a period of time. Because there is no one track or one path strategy. You have to keep changing as you grow.
Okay, so next one. Um, how to select a buyer's agents. Let's do a proper session on this because there are so many good points in this we can cover.
Yeah, but watch this webinar and you'll get to know.
Maybe someone who's educated and has a good portfolio done for himself, built a great portfolio for others as well, and is willing to share information with others as well, and has good reviews. I think these would be some good criteria to look into a good buyer's agent. I can and also speak to other professionals and see what their whole profile looks like online, and what they do. So that will give you an idea and insight about someone, because there are buyer's agents are growing by the day, right? Everyone is a buyer's agent. Everyone is a property expert. There is no regulation in the industry. You just need 6 day course. Not even takes you about 6 days to get that license for real estate. And even sales agents, stock sellers, everyone is calling them a buyer's agent. So you need a really good one. Um, we can do a proper session on this, Ashish.
I think we can, but just to answer this, understand the point of view and mentality and the working style and the investing style of others. When they tell about their portfolio, understand where they've invested and what's their mindset around investing is. If they are actually neutral in their suggestions or they have certain notions, because then you can only do what they want you to do. Also understand the terms and conditions of how they run their buyers agency. Are they willing to be flexible a little bit? Do they run a team? Are they a big machine that would treat you as a number, or you need a better relationship with someone or a balance somewhere? Um, um, Check the industry associations, REBA, for example, QPIA, which is Qualified Property Investment Advisor, PIPA, Property Investment Professionals of Australia. I think REBA is the biggest. It's not just money, but the REBA tracks your reviews. They also check whether you are only working as a buyer's agent. You have to be in the industry for 2 years, and you need to have processes and operational things in place. So I think these are few things. But even if you just ask Chat GPT, and it will just spit out a lot of suggestions on how
That
you
is the
can follow.
reason, Ashish, why we don't do chat GPT things, because we want to give a personal experience in that. Chat GPT is going to throw out a generalized answer based on their preferences, right? That's when they come to reach out to experienced people in the industry so that they can give their own perspective about things, how reality is, which chat GPT is not aware of. Chat GPT, if you throw out, give me the best suburbs, it's going to give you Townsville and all, which are still doing well, but still not the most accurate answers. That's when, they come to people who know this stuff. So I think that's very good reason to do another session, and we can give proper insights, not with what chat gpt is going to spit out. uh, so let's put that on the list. And next, second last question is from Vandan. Vandan says, what is your strategy when a property ticks most boxes but not all, like from all the parameters that you have? How do you decide whether to compromise, and when to act versus wait? Ashish, do you want to take that?
Look, you know what? Any decent property I get at any discount, I'll just jump on it. One thing that has really worked for me is just being decisive. For example, my last property, which I bought under SMSF, is on 242 square meter land, a double story home. I've been always advising don't buy double story homes, but the single story homes, are a 3 bed, 2 bath, single garage is selling for 580, 570. And I've bought the property for 595, which is double story, actually a 4 bedroom house. And that's where my rental is 590 as well. I'll buy it in a heartbeat. When I was buying my office space, everyone was haggling with the agent for $15,000. And I went to the agent and I said, look, I don't want $15,000 haggling. I'll pay you happily. I need a good location. I'm only looking at corner block. And to my amazement, the agent calls me in the evening and says, A contract has fallen through. We are selling at 13,500 a square meter. That property is available for 12,700. I can get you at the same price. Apparently, he was also talking to someone else who was still haggling on that price as well. I just said, I'm happy. Let's go in. So to me, location is most important thing, followed by a well-maintained property. Rooms small, kitchen small. Honestly, I don't care. Why? Because everything grows if you've bought well. So if you put in check boxes like, very nice looking house, very spacious rooms, I think you're thinking in a different mindset of maybe an owner occupier, not an investor. So when you say property is ticking most boxes but not all, I'm not sure what your boxes are. And my boxes are literally very small. I chuck away all the boxes. I'll just
Deal
make sure it's the
breakers,
right property.
the deal breakers would be like, as we discussed earlier, buying right next into the community housing, just next door. It doesn't have to be like community housing on the street if you're buying next door where there's high crime rate, because your tenants are going to live in that place, right? They want to be feel safe and secure. That's when you will keep getting tenants. And the location also determines the tenants you are getting. If you're buying for low price point or whatever, like you get good rent, good rental yield on paper, but the location itself, the lane itself is known for being notorious or have some criminal activity in that, your tenant turnover would be more. The tenants you will get will also be potentially in the same profile who are going to fit with others in the who are living in that same lane. So you want to be
So,
cautious of those things. You don't want to be buying in extreme flood zones or extreme bushfire zones where insurance cost is too high. So that's when you can like eliminate those properties from your profile and be like, nah, this is a deal breaker. This is what I don't want to do. Go ahead with. Um, so I think that covers Vandan's answer as well. Now, the most important question that is, where are you buying, Ashish? Just the three suburbs that you feel sharing with, which have good value in them and can grow in the next 2, 3
look,
years.
as a full disclosure, yes, we've talked on Craigieburn a lot. I've bought there. Mickleham, I have bought just now my last property there. Victoria, I love Geelong. Um, if I have to really give one suburb that has worked wonders for me, and I'll buy there still in a heartbeat, is Lara. But your budget is 650 to 680. You can look at Bendigo and Ballarat and around that half a million mark. Now, coming to New South Wales, I've been buying around Central Coast and Newcastle. I've just logged in the last land that I've logged in. Of course, it's development site, but I'm doing a development across Badgerys Creek precinct. I really love it. I reckon people miss out on those areas like Cambridge Park, Kings Park, Warrington County, and those pockets. Newcastle is pretty good as well. You can buy something for 700 to 750 and get a rental of 700 to 750 and build a granny at the back. So that's the sort of strategy I follow for clients at times. Queensland, so from Ipswich to Toowoomba, but I think we are about to, I think we would be about to exit from there. Um, I don't see much of value buying in other states. And I've just logged in. Now, don't get me wrong, I don't do house and land packages, but there is one area where I'm buying and building a home for 800,000 and the similar home is selling for 910. So I have negotiated 8 lots from a developer, and I've got a very small audience that would like to get in and get out. So I'm saying there's 100K now, but I've taken a 15-month settlement plus 7 months for the build. We're talking 2 years. I reckon this property is going to give us 220 to 250 straight away, and you have development finance too. So I think don't close your eyes as an investor. See what makes you money and different strategies, but work out your numbers, which is the most important thing.
Great answer. We were not expecting that. This is too much value for the last bit itself. I think that, that would conclude the session for us here. So thank you again, Ashish, for giving all this knowledge and sharing everything that you did. It's too much value, too much to process, and I hope people who stayed till the end as well really appreciate you, everyone. And I hope you got some value out of that. And
I think
yeah,
Rahul, there's few more questions I can see.
is there?
So yeah, there's
We
one.
covered most of them.
I'll just go from the top again. It says which areas are you buying in? We've answered that, so I'll mark it as done. The second is herd units depreciating. Many properties sold for less
No, we
than.
already
I think
covered that.
we
We
answered
just
that.
did not.
We
Yeah,
answered
we
that.
covered
Yeah, yeah.
everything.
No, so
There's just one
there's
more left. There's one more. What about South Australia and Western Australia?
South Australia, Western Australia, I think has grown. Western Australia may run again, but I'll wait for another 1 or 2 years to see that. Um, yeah, just that's when South Australia historically in 15 to 18 years goes up in 3 to 5 years and then
Yeah.
stagnates between 1 and 3%. So I'm
Not
a
a
bit
property
concerned.
person. I'm not a property expert or anything. I'm just finance. But South Australia has been one of the safest bets, depending on locations. There's always going to be steady growth. You may not get that growth spurt of 1 2 years as you got in Perth in COVID or post COVID, or those sort of growths in those locations. But you will never be disappointed in South Australia. That's just how the state works.
But that's the point. Like we were buying properties anywhere between 350 to 420 around 2021, and those properties are sitting at 650 to 680. Some are even at 720. So this is where when I was talking about Subir's portfolio, one property we bought in South Australia, I reckon because that growth spurt has gone anywhere between 1 and 3% is again you're talking 21, 22 years for your property to double in value, and you're still very negative in cash flow, and that's I think some red flags there.
Okay. The last question: would you buy on a sloppy land in a very good location or flat land in a good location, Ashish?
Um, so a sloppy land, slopey, sorry, I think that's slopey. A slopey land
Yeah, the spell.
would mean there is a drop in value. So it depends how much slope is there. 1 meters, 1.5 meter is fine. Sometimes there's retaining walls, it's fine. But if there's a lot of wastage of land, I'd rather buy a flat land in a smaller land with a decent home. So that's fairly what I would look at.
Perfect. So I think we covered everything. Did we leave out anything here?
Uh,
Sorry, where he mentioned the Queensland suburb. Ashish, Afdal wants to know which Queensland suburb did you mention?
did I mention any
Mackay?
Queensland suburb?
I think you were saying something about Mackay or Toowoomba. Ipswich.
Yeah, so I was talking from Ipswich to Toowoomba. There's ample pockets there, still fairly affordable. You can get in at 620 to 650. The rental is 550 to 570, so that's actually not bad. And the land size is 600 to 800, and on 800 you can build a secondary dwelling as well.
Perfect. So we will be in touch and we will just send you an email. And Ashish, as a gesture of token of appreciation, he's offering discounts to anyone who feels like they got some value out of that and still want to reach out to a biased agent. If you want to go ahead on your own, this is your chance and learn from Ashish. And then, but if you still feel don't have enough time, feel free to reach out to him for anything. For mortgages, finances, feel free to reach out to me anytime. You will receive emails and contact details from us as well. And thank you again for coming in.
And Ken, heartfelt thank you for all 40 people that have stayed for this long. I really appreciate that. We literally took 2.5 hours for the session. I do appreciate everyone's time equally. I know there was value, but again, I do appreciate everyone's time. So thank you.
Thank you, Rob. Thank you.